Hello friends, welcome to my channel TJ the Tax Accountant. Please remember to subscribe to my channel and hit the bell icon so that you can get notification whenever new content is added. So moving on to the basics of tax accounting, our topic of the day is what is uncertain tax position. Uncertain tax position is made up of three things, namely uncertain, tax, and positions. So uncertain means wherever the application of law or regulation is not in sync with the facts of the transaction that you have reported on your tax return. The guidance regarding the application of law is not clear or it's vague, and there is no precedent set by any court case for that position, or the data or information is not available to calculate your transaction properly for your tax return, or the transaction that you are reporting on your tax return hasn't been reported consistently, so you may have treated it in a different manner in a prior period than you are planning it to treat in the current period. So the other component is tax. So when we talk about uncertain tax positions, we only refer to income tax. We do not include VAT, sales tax, property tax, payroll tax, or any other kind of above the line tax when we talk about uncertain tax positions. The third component is positions. So what does exactly a position mean? So position means the stand that you have taken on the tax return, the way you have declared your deduction or your income on the tax return. You may have claimed certain kind of reduction. You may have claimed that a certain kind of income is exempt from being taxed. The classification or characterization of transaction. You may treat something as an expense whereas it could be capitalized. So those are the kind of positions which can create uncertainty. So what to do when you have uncertain tax position? So the first step obviously is to recognize it. And the way to recognize any uncertain tax position is to primarily determine its effect on your financial statement. You should recognize the uncertain tax position based on its technical merits, and you should recognize it. You should create a reserve if you think there is a chance that you may not be able to sustain that tax position in your tax in the case of a tax audit. And any position which is more likely than not to be sustained and the chances are greater than 50% are the ones for which you do not need to create a UTP accrual. And the assumptions for recognition are the primary assumption is that whatever you have declared on your tax return is subject to an audit. You cannot assume that your organization will not be subject to a tax audit. The evaluation should always be done on technical merits of the case. You should not go by the gut feeling of your management. And any conclusion that you take while determining your uncertain tax position should be based on law or fact of the law. Generally, we use any decision in a similar matter issued by the Supreme Court. So moving on to the next aspect of UTP, which is measurement. So as we discussed, the position that we measure should breach the more likely than not threshold, and then when it does not breach it, then that's where you have to create a UTP reserve. And the UTP reserves are always created before considering any valuation allowance. We'll discuss what are valuation allowance in a different session. I will be soon uploading a video on valuation allowance. And the other aspects of measurements are accrual of interest and penalties. So if you are recognizing a position as uncertain, then you should go by the assumption that you will be required to pay the interest on the unpaid amount of tax, and you may be subject to certain penalties based on the tax laws applicable in your country. So the last piece of UTPs with respect to their recognition is the subsequent measurement and derecognition. So you can recognize a UTP for the first time, but then you have to review it every year to make sure that it is still valid. There are some triggering events wherein you can release a previously recognized uncertain tax position. Those reasons could include expiration of statute of limitation, closure of any current audits, any negotiation that you have agreed upon, like an advance pricing agreement with tax authority, any litigation which has been settled, which involves a similar transaction that you are currently accruing for, or any subsequent change in the laws or any court case in a similar matter. So lastly, some key items for UTPs. So UTPs, when you recognize a UTP, you have to create a long-term liability in your balance sheet. But before you do that, you need to make sure that there are no loss carry forwards which you can use to pay off the tax liability. So in that case, you would reduce your deferred tax asset, which would already be there on your balance sheet, by the amount of UTP, rather than booking a long-term liability. And as we discussed before, UTPs are always recognized before you adjust your DTAs with valuation allowance. And then UTPs are always recorded discretely when the when the transaction in question is from a prior period, and that amount doesn't affect your effective tax rate for the current year. However, if your uncertain tax position is for the current year, then it should flow through your current tax expense and it will impact your effective tax rate. And to know more about what are the basics of effective tax rate, please refer to my video on effective tax rate on my channel. And I hope you have found this video useful to learn about uncertain tax position and its basics. And if you like the video, then please do subscribe. I have many more topics to cover. I will soon be doing a new video on basic differences in book and tax. And I will also share some key Excel tips which will help you to create various worksheets that are related to tax accounting and will help you in your work, or if you are in college, then it might help you with your project work. So till then, stay fit, stay healthy, be safe, and keep watching my videos. Thank you.